Good morning. Happy February. Wanted to be able to share a market update with you and go over some statistics from our Greater Lansing market, as well as the economy as a whole, to give you an idea of where, in my opinion, our real estate market here is going to be going and why that's important. Um, in general, I would say the math does not match the perception of the media and our real estate market, which appears by all accounts to be looking pretty healthy starting out the year here in 2023. And here's some of the evidence behind that. These are the graphs that I look at daily. They're updated every month, but it keeps the information fresh in my mind as we look at our perspectives for the decisions we need to be making and guiding our buyers through real estate transactions. Prices is probably the one most people are interested in. Red line here shows our active median list price. That's the middle ground of all homes that are currently on the market. An interesting tick here is that we have a split where our median active listing prices went up to 214, where our sold median list prices took a drop to 176. That's the lowest price point we have seen for a median sale price in over a year. We can also see that our new listings, so as new listings hit, we have a new graph line chart here. You can see that that also took a slight dip in January to match our sold listings. However, what that means is our absorption rate, which is this graph here, has dropped consecutively now for 2 months in a row. The lower the absorption rate, generally speaking, the stronger the seller's market and the healthier the market is overall. We are seeing days on market extend, which those two should normally go together. And so that's a little bit of a split here. And I believe that that's showing, coming back to our prices, that higher priced homes are sitting on the market longer, which is skewing our sold days on market average. Our inventory has been dropping. The red line here is our active inventory. Black is again our sold, and gold is our new listings. So we can see new listings have been dropping steadily since our peak at almost 900 homes in July of last year, and we've been dropping since, with a little bit of a steeper drop off into December, which is normal with our seasonality. We did have a few new listings hit the market in January. That's a good sign. Our market's starting to warm up. We always see some of that seasonality in Michigan. We can also see that our sold listings dropped. So this gap here between our sold listings and our active listings on the market is what makes up our inventory. Our inventory today, you can see that we peaked our inventory last year in June at 642 on the market. And again, we have 898 homes hitting the market, but we have 642 homes sitting on the market. That means 30% of homes are selling immediately as soon as they hit the market. That's a pretty fast, healthy market. What I want to show you is where we're sitting in our active listing count today. And so if we take a look at just our Greater Lansing MLS and look at only properties that are actively for sale, this is going to include all of our residential homes. So this doesn't count our multifamily properties, but you can see that we're sitting at under 500. So under 500 is about 25 to 30% of what we would call a balanced market. We anticipate or expect 1,500 homes to be an equal market where our absorption rate balances out at 4 months, meaning that there is not an advantage to either party in a real estate transaction. And that means that we have a slower market, but a very healthy one. Right now, we have a very fast seller-centric market. So we're starting to see more difficulty for buyers again because of that lack of inventory. Now, what happens when we have lack of inventory and high demand from buyers? Prices are stable to increasing. And if we go back to our homepage and take a look at that, again, we have our active median list price on the uptick. So I think that's what we're going to be looking at going into 2023. Some other points that are really relevant and just understanding the market as a historical perspective and as a whole, taking a look at our home prices year over year, so an annual basis, you can see this yellow line is our trend line. That's the 4% appreciation that we kind of expect. That is kind of the golden standard for real estate. And you can see since 1991, we've been tracking that. We did have our early 2000s years that created that real estate bubble, primarily due to subprime lending. And then we had our subsequent real estate crash and the Great Recession, which kind of bottomed out in 11, and we started that climb in 12. And even though we're below where that line would have been had that crash not happened, we're still mimicking and following that 4% trend line every year since 2011 moving forward until we have COVID event. We did have a market. The good news is this bubble here, not nearly the same market as this because we have more strength in lending practices. And the biggest challenge is that we still don't have inventory. In 2006 through 2007, 2008, we had over 4 million homes on the market in the United States. And we have 20 years of population growth and growth in income over this time. And yet we don't have new home construction and we don't have available inventory right now. Our available inventory nationwide is sitting at just about 1 million homes, 1.25 million. And so taking a look at our mortgage rates are the biggest objection or the biggest concern people have in today's market. And I want you to look at, other than the crazy high interest era of the late 70s through the 80s, if we look at our trend line from 1990 forward, we have an average historical of 5.97. We're projected to drop down to as low as 5.4. And the reason we expect those rates to drop is the mortgage industry has got a lot of respect and is really responding positively to the Fed's movements. Now, the Fed is meeting today. According to all of the information that I can garner and this USA Today article from a few minutes ago, the Fed is expected to raise interest rates only 1/4 percentage point, which is a traditional rate increase. And that also indicates that they're looking at really finding that soft landing zone as inflation has been declining for 6 months straight. And so those are all really good news for our overall economy. And I think that's going to have a positive effect on our housing market. If we look at the fixed interest mortgage rates for a 30-year, you can see over the last year, rates peaked in October, just about 7.32%, and they've been declining pretty steadily since. And we've had some daily fluctuations. Today, we're having a little bit of a drop. We're at 6.17 as of right now. And I suspect that after today's announcement from the Fed, we might see some volatility there, up or down, doesn't really matter. I do expect that we're going to continue to see this downward trend through this year. And when rates get below that 5.5% mark, that's only going to equal more sales and more buying power for consumers, which will continue to keep inventory low, continue to keep prices stable to rising. And I think we're going to be set to have a fantastic year for our sellers. Our buyers are still able to get into homes at quality interest rates. There are lots of opportunities to mortgage hack and get interest rates down back to where they were last year through mortgage buy downs or through lowering our overall cost of a mortgage by paying down principal early on in that mortgage. So lots of options out there. Our team is ready and educated to make sure that we can help our buyers and our sellers make great decisions. And I hope you appreciate the market information. I look forward to giving you an update again in a few weeks. Thanks.